Hi guys, this is Dr. Satya from Stock Market Files. In this video, we'll learn about long strangle. So we already learned about a long straddle and short straddle. In the long straddle, we used to buy call option and put option of same strike. Here in long strangle, we will buy call option and put option of different strikes, right? Different strike price, right? So buying a call option and put option of different strike price is called as long strangle, right? For example, let us consider a Reliance stock. Underlying stock we are considering is Reliance Industries. Let's say we'll be buying a 2100 CE and 1900 P, that is 2100 call option and 1900 put option. We'll be buying both. You see, these are different strike price. This 2100 call option and 1900 put option, they are different strike price. Now let us say for buying this 2100 call option we are paying 20 rupees, and for buying 1900 put option we are paying rupees 30, right? So what is the cost of this triangle? Because I am buying both put and call. So I'll be paying in total this plus this, that is 20 plus 30. So in total I'll be paying 50 rupees. In total I'll be paying 50 rupees. So that is the cost of this triangle. That is the cost of this triangle. Now let us consider various spot prices and what will be our total profit and loss by having this triangle. So let us say the market or stock has moved to 1700. So in this case, our call option will be out of money. It will have no value. It will have no value, right? Because our call option is 2100 call option and the market is trading at 1700. So call option will be zero. So what will be put option? Now we have bought a put option of 1900 and the market is trading below 1900, 200 points below 1900. So put option will give me 200 points profit or 200 rupees profit, right? So call option value is 0, put option is giving me 200, and my cost of this triangle was 50 rupees, right? So that is minus 50 because I have paid it already. So that's why this is minus 50. So what is my total profit and loss? 200 from here minus 50. So my total PNL is 150. Now let us say Reliance is trading at 1750. So again, my call option is out of the money. It will have zero value for me. And put option will give me 150 points profit. Why? Because my put option is of 1900. This put option is 19 PE and this is 2100 C, right? So this is zero and market is, put option gives profit to a buyer when market trades below the strike price, right? So our strike price is 1900, market is trading 150 points below this 1900. So my profit is 150 rupees from this put option. My strangle cost, which I have already paid, is minus 50. So my total profit loss is 150 minus 50, that is 100 rupees. Similarly, when I am on 1800, when the market is on 1800, C is 0, this will be 100, this is minus 50, so 100 minus 50 is 50. So now when the market is at 1850, right? So C is again out of the money, it is 0. So P this time will give me only 50 rupees, right? And my cost of the strangle is minus 50. So 50 plus 50 minus 50 is 0. So this is a point where I am making no profit, no loss. No profit, no loss means this is my break-even point. So I can call it as a break-even point or BEP, right? So now let us move on and let's see what happens at 1900. At 1900, my C will be out of money. It will give me 0 and my P will also have no value now because my strike price is 1900 and at maturity market is trading at 1900. So P also is of no use. So it is also 0, right? So both are 0. I have already paid 50 rupees. So my cost, my total profit and loss will be minus 50, right? So at 1950, C is out of money. Now this time PE is also out of money, right? Because I have bought a PE of 1900, right? But the market has moved up, so this P is of no value. So strangle cost is minus 50, so my total cost is minus 50. Similarly, at 2000 also, both are zero, profit loss is minus 50. So at 2050, again profit loss is minus 50. At 2100, again, C has no value and P is already out of money, so my cost was minus 50, so my total profit loss is minus 50. Now at 2150, you see, at 2150, right? So my CE, I have bought a CE of 2100, so market has moved up 50 points. So I'll be getting a benefit of 50 rupees from CE, but as P is out of the money, P is zero. So my total, my strangle cost was 50. So my total profit and loss will be 50 minus 50, that is zero, right? Again, this is a point where I am making no profit, no loss. So this is again BEP, break even point on the higher side. This is the break even point on the lower side. This is the break even point on the higher side. We have two break even points here, right? And you can observe if the market is remaining in this range, I am making a loss as an option buyer. I am making a loss of the premium, right? 50 rupees premium I have paid. So that much loss I am making. Right? But as the market moves beyond this 2150, that means let's say market move to 200, 2200. So what I'm getting from CE, I'm getting 100 rupees profit. P is zero. So my cost of strangle is minus 50. So 100 minus 50 is plus 50. 50 rupees profit I'm making. Now let's go to 2300 directly. So if the stock moves to 2300, so the profit which I am getting from C is 200 rupees because my C is of 2100. So I'll be getting profit of 200 rupees from here. P is making zero PNL because it's out of the money, it's of no value. So now cost of the strangle was 50, that is minus 50. So my total profit loss is 200 minus 50 is 150, right? So I'm making a profit of 150 here. So as the market moves above, higher, I'll be making a much more profits, right? So the point to note is if the market breaks this range, break this point, that is 1850 on the lower side, I as a strangle buyer or my strangle will make a profit, make me unlimited profit, right? And as the market moves higher than 2150, I'll be making unlimited profits. But if the market remains in this range, I'll be making a loss of the premium which I have already paid. Okay? So what can we conclude from this? We can conclude from this, if I have a volatile view about the stock or the market, I should go for the long strangle. That means I know that the market is going to move on either upper side or lower side. I know that definitely market is going to make that move, but I don't know on what side it will be making that move. So that time I can make this, I can use the strategy of buying a long strangle, right? Okay, so now let's talk about the upper break-even point. So upper break-even point, we saw it was 2150. How I got that? The formula is C strike price, call option strike price plus cost of the strangle. So that is 2100 plus 50. So C strike price is 2100. We have got the C of 2100. Cost of the strangle is 50. So the total, so upper break-even point is 2150, right? That means if the market moves above 2150, I'll be making profits, right? But at 2150, I'll be making no profit, no loss. So lower break-even point is the P strike price, right? Which in our case is 1900. We have bought a P of 1900 minus the cost of the strangle, which is 50, right? So the break-even point which we got was 1850. So this is the formula for the lower break-even point and upper break-even point. So at these both points, we are making no profit, no loss, right? So that's why they are called as break-even points. But as the market moves below 1850, our PE will start giving us profits, unlimited profits. As the market moves above 2150, our CE will start giving us profits. So when to buy the long strangle? When we have a volatile view about the market, right? That is, we feel that market will strongly move on either one side, either upper side or lower side. We don't know, but we know that it will surely move, right? And that time we can think of buying this long strangle, right? So the long strangle makes profit when the market moves beyond BEP, right? Either on higher side or on lower side. If the market remains in the range uh, between those BEPs, if the market remains there, I'm going to lose the premium, right? So that was the long strangle. I hope it will help you to make a better strategy for buying options. So thank you so much, guys, for watching this. Please stay tuned to watch other videos on other strategies. Thank you.